fund house in India to launch Nifty 50 equal weight index fund. The strategy has played out beautifully. Just to give you some stats, over the last 5 years, the fund has delivered almost 4% alpha. Taking a leaf out of that, we are very happy to announce the launch of India's first top 10 Nifty 50 top 10 equal weight index fund. To throw some light on that, we have Sahil Kapoor. Sahil is a market strategist and head of products at DSP Mutual Fund. What works in this fund, what may not, we have Sahil. So over to you, Sahil. Maybe you can throw some more light on the fund. Why an investor or why an advisor during this market should probably suggest or allocate to their portfolio this particular strategy.
Sure. Thank you, Ankur, and welcome everyone. So Nifty top 10 equal weight index was released by NSE just last month, and we think that this is one of the better index structures. And you highlighted this strategy called equal weight, right? So DSP as a fund house was one of the pioneers to bring this strategy, which is a global strategy, to India. Just to give a 30-second outlook on what equal weight is, I think it's one of the simplest strategies out there. So when we start analyzing and we want to know what are the key factors which can impact investments. For example, let's assume that an analyst or investor believes that earnings drives returns, okay? So, and then they want to see, for example, what is the change in earnings or EPS of a company and what could be the commensurate impact on the stock price.
Sure.
So if they create an algo which tells them if earnings go up by 10%, stock price should also go up by 10%. This is one simple one factor, usage of one variable to understand the returns. Now there are people who want to have 20 variables or 30 variables. So they will put together another formula which will tell them what should be the impact on the price. But there are so many variables that it is very, very hard to know, what will be the key impact. So one of the easiest way to account for everything is to do an equal weight, right? Which means that when you equal weight all the stocks in an index, what it does is that it gives you equality for all the reasons for which earnings or any other factor can impact the price. So it's a strategy which has been in force statistically for now over 70 years. It was first found out to be logical and rational in 1963. And since then, this strategy in some form or fashion has done well over time. It also is a cyclical strategy. There is no doubt about it. It will have its own cycles, but it's a fundamentally, logically, statistically sound principle of investing. So with that, we'll start and we'll talk about what this structure is and why is it important. But I want to highlight 2-3 points before I jump into, Nifty top 10 equal weight index, which is what we are going to discuss today. So just a few years ago, a lot of people were talking about this concept of big becoming bigger. Big becoming bigger was a concept where investors thought that companies which are very large because of the size of their balance sheet, their ability to attract talent, their ability to invest in technology will be able to gain an upper hand versus the smaller companies, which will find it tough specifically in that post-COVID environment. And they will deliver the returns, the largest companies or the bigger companies, and therefore the theme big becoming bigger. It played out in United States and in some other markets, but in India, people have forgotten, right? People have forgotten that phrase because small and mid cap delivered huge returns, right? And if you see, the chart on your screen, it depicts two lines. One is the red line, which is going up, showing that the top 10 companies in S&P 500 has outperformed S&P 500,
Correct.
right?
Correct.
Showing this trend of big becoming bigger, or what is also called polarization. Domestically, the opposite happened, right? Larger companies underperformed, small and mid caps outperformed. At this point in time, we think that these trends are ripe for a reversal. When will the reversal occur? We have no idea, but we have reached a stage where these larger companies have become a lot more favorable. I will show some statistics when I run through the presentation. But the key point is that the trend which has played out in US of big becoming bigger, that same trend domestically is at an inflection point in India, right? It's at, you could say it has better margin of safety, right? Whether it turns from here or not, is anybody's guess, but we often say that this is a good time to play this trend, may not be the best time because nobody knows which is the best time, right? So that is the idea. Second thing, over the last 6 years, only 1 out of 10 rupees flowing towards active funds in India has gone to large caps. Rest of the 9 rupees has gone to thematics, sectors, small and mid caps. Largely we think it is because those categories have outperformed, they have shown performance, but we believe that small and mid caps and thematic funds largely are slightly more pricier compared to large caps, and large caps are also devoid of investor flows right now. So our idea is that you should possibly look at that segment of the market which the rest of the market is not looking at, which is the large cap segment, and the whole market, the whole investor community is right now more geared, more looking at more favorably towards thematics. What we are telling investors, look the other way, take slightly more contra opinion, and this, the chart on your screen shows the same thing, that how fund flow has gone to, if you look at the black bars, which is the thematic and sector funds, the green bars, which is small and mid caps, although large cap category, which is 70% of overall market cap, more than 70% of overall profits, more than 70% of free cash flow, the full large cap category of 100 stocks, but has received just 10% of the flows.
So I remember one of your Netra charts in 2022 had suggested an opportunity in small and mid caps.
Absolutely.
Right. And in your August Netra, you are talking about an opportunity which is where the mid and small caps probably has kind of played out.
Yes.
And correct me if I'm wrong. And now probably the opportunity is in large cap and more towards the top 10 in terms of equal weight. What
Absolutely.
you are, what we are trying to construct and propose.
Sure. So 2 years ago, as you said, that was a time where small and mid caps were trading at a discount to large caps.
Right.
They were not getting sufficient flows also. Investor interest was not there. Today, the idea is completely opposite, where large caps do not have flows. They are also trading at a discount to small and mid caps. So I think it makes a lot more sense in terms of margin of safety. The third idea is that from a momentum perspective also, large caps are now more favorable.
Sure.
So currently the other segment of the market, which is mid and small cap, on a relative basis is trading at a lifetime high versus the large cap, and the momentum which has favored the non-large cap segment is sort of waning. It's going away, right? It's flattening and coming down, which tells you that from an all-time high, if a momentum indicator is telling you that it's going away, there is a good likelihood that this is the place to prefer large caps.
Okay.
And why am I emphasizing large cap? Because now I'm going to talk about the largest cap, right? Which is the topic for today. And for now, I have told you that large cap is a better play.
Sure.
But our sense is that large cap might be, the play, or relatively a better play even than the, large cap. So we'll talk about the largest cap. So this index, which I'm talking about today, which is the Nifty top 10 equal weight index, is comprises of the top 10 stocks of Nifty 50, but they're equal weighted. So 10 stocks, each of them having 10% weight. And how do we arrive at this index? So the large cap universe is the top 100 stocks. Nifty 50 is the top 50 among them. And the top 10 among Nifty 50 will comprise of this index. And this is a very, very simple index. And you can say that you are using the wisdom of the market to arrive at the top 10 stocks.
Okay.
There is no other filter, no other criteria of any other factor, but only the market factor.
And no human bias.
No human bias. It's a passive index. And the amazing thing is that over the last 10 years, there are only two churn which has happened in this index. Okay, so a lot of people will not even believe it that in the top 10 stocks, there are hardly any changes which have happened in India, which also tells you that there is something very durable about the largest cap companies in India.
Sure.
Right? And in behavioral finance, it is the Lindy effect which Taleb has used, which means that something which has lasted for a while, for example, let's say 30 years, has a probability of lasting another similar time in the future. And so this is a very durable portfolio, and also these top 10 stocks have a lot going on for them, which we will discuss now. One is that over the last 19-20 years, this index, which is Nifty Top 10 Equal Weight Index, which is just 10 stocks, has outperformed the broader market, which is Nifty 50 index and the Nifty 500 index. So broader market, narrow market, which is Nifty 50, and the Nifty 100 also. So it has outperformed all the indices per se over the full cycle. Okay, this is something which is
not much talked about.
Not much talked about, which means that what I'm saying is that whether you take the Nifty 50, whether you take 100, which is the large cap universe, or even 500 stocks, okay, the top 10 stocks over the full cycle has outperformed each one of these categories over the full cycle. So it's and I'll emphasize that over the full cycle, because there are phases in between where the other segments of the market will do well. For example, over the last 3 years, the small and mid cap universe has done much better than the large cap and the largest cap universe. Okay. So it's more cyclical, and we'll talk about the cycle. But what is interesting is that an equal weighted 10 stock concentrated portfolio beating a very well diversified large portfolio. Okay, and almost sounds impossible, but it is what it is.
But according to you, this outperformance would have come due to certain momentum factors, or there are some inherent fundamental factors which probably would have led to this outperformance? Like if you can discuss a couple of ratios.
So inherently, I think these larger companies have one of the strongest balance sheets. So they are able to withstand lot of uncertain environments, and that goes for them. In the broader market, lot of companies are unable to withstand crisis. So this is something which helps the larger companies over a very long period of time.
Sure.
And second thing is that many of these large cap companies are also market leaders.
Okay.
Most of them are either one or two in their own sector, and that gives them the advantage of garnering larger profit pools, having better balance sheets. So these things have, I think, worked in favor of these companies. And also remember that this is an equal weight index,
sure,
which has an inherent ability to book profits at every rebalance. So we'll talk about that, but I want to highlight two specific years. So just about 5-6 years ago, there was a term being used called Ritik stocks. Very large stocks outperforming everything else in India. Specifically on your screen, if you see the years 2018 and 19 in the heat map that I'm showing, you will see that the broader market, which is Nifty 500, fell 2% in 2018 calendar year, and in 2019 it rose only 9%.
Correct.
While the equal weight top 10 stock equal weight index rose 19% in each of those years.
Wow.
Right? Which means that while the broader market did not do much, this set of stocks did exceedingly well, right? And this is what is called the polarization phase. And that was, of course, the bottom of the depolarization phase post that. And that is where we launched the Nifty 50 equal weight index, right?
So if you can spend a little, couple of minutes to expand a little more on polarization and depolarization.
Sure.
And
yeah. So, to understand this, I think one way to understand this is first look at Nifty 50. It's a market cap, free flow market cap weighted index, a good representation of the broader market. Now, if you want to beat Nifty, what is the best way to do it, right? Let's assume that you have a phase where top 10, top 15, top 20 stocks are the only ones which are doing well, just like 2018 or 19. Right. And the broader market is not doing so much, right? And you see that the broader market has reached sort of a point where valuations are cheap, no price froth is present. At that point, one strategy which works very well, which we adopted, is to create a portfolio of equal weighted Nifty 50 stocks, which is called Nifty 50 equal weight index. So in Nifty, you have 50 stocks, everything has a different weightage, right, based on their free float. For example, a Reliance or HDFC has 10% plus weight, but in an equal weight portfolio, everything has 2%, 50 stocks, 2% each.
Right.
So when the markets rallied and the tail of the portfolio did very well, that index beat everything else.
True.
Over the cycle. now we are at a point, and this is called a sort of a depolarized market, where everything else is doing very, very well, right? So for example, one way to think about is what is being right now said as a unipolar or bipolar world. Earlier it was unipolar, where only one country was the key. Now there are bipolar, where you are seeing two blocks emerging globally. We are talking about depolarization, where everything is doing well, right?
Right.
And polarization, of course, I explained, very few stocks doing well. So currently we are in a state where we are at the peak of depolarization. All broader market stocks are doing very, very well. The past returns of, or recent returns of, the large cap, the largest cap companies is low. Okay, they haven't done as well. So if you, even if you look at this heat map, in the year 2023, the largest companies gave 21% returns, while the broader market gave 27. This year, calendar year, largest 10 companies gave 11%, while the broader market for now has done 22%. So there is a very large differential, and this is the differential which tells you that maybe this is the right time to go the opposite way, go with the largest cap companies, right? Another important point is that over a full cycle, over a 10-year period, the median rolling returns for this index is about 14%, which is almost 2% in excess of the broader market. Okay. And we are talking about this data point today. And this is the day when the broader market has done exceedingly well over the last 4-5 years. Even including that, the rolling returns for the top 10 index continues to be very healthy, which tells you that it has done well over a period of full cycle. Third critical point, if you compare, let's say, Nifty top 10 equal weight index versus the Nifty 50 or the Nifty 500 index, at this time it is at a low cycle, which means it is underperforming. So if you were to create a 3-year rolling alpha, which is what there is on your screen, the dark blue line, the 3-year rolling alpha, it is somewhere negative right now in the lower category, closer to the lows that we've seen historically. And when we enter this kind of a strategy in this period, there are chances that the forward 3-year alpha will be higher, which means that when you enter a tactical strategy at a place where it has margin of safety, there is a good likelihood that future returns could be better.
And typically when you are buying into an underperformance at this point of time, you are likely to benefit once the whole cycle reverses.
Absolutely, and we are buying into underperformance in a set of companies which are very robust. We are not, buying, let's say, broader market where you have to be very careful in selecting what you're doing. These are the top 10 companies.
And also, not these companies have, weak financial metrics.
Absolutely, all of them are market leaders. And also, I wanted to highlight this point that a lot of people have now realized and of course pointed out that India's market cap to GDP is now exceeding very large numbers, 150%, right? Our all India market capitalization now is $5 trillion, more than that. We haven't seen these kind of numbers. Over the last 3 to 4 years, the addition to India's market capitalization has happened because many small and mid-cap companies have done exceedingly well. Also, there are number of new issuances which have come into the market, right? But the point is that all these new issuances, small and mid-cap stocks, are trading at multiples which are much larger. Okay, so the new market cap addition which has happened with a portfolio of stocks which has lesser profitability compared to the top 10 largest stocks. Okay, so we drew a ratio of market capitalization of top 10 stocks versus the total market capitalization. That number right now is at a lifetime low. Which means that highly profitable, highly robust financial position companies, which are the top 10 firms, currently are at their lowest level versus the rest of the market.
So what would be that ratio at this point of time?
So they are roughly at about 20%, lower than 20%. At the peak, they were 40%. But the peak is a misnomer. You could say that it generally is at about 30%. But this number has, gone back to a lifetime low.
Should this be one of the factors while allocating before into a strategy like this, that the weight of the top 10 index is at the lowest? Probably tomorrow, if it goes a little high, or
Right.
maybe it's at the peak. Will somebody or should somebody still be, consider allocating into this kind of strategy?
Sure, it's a very good question, and I thought about it, right? That is this just a tactical strategy,
Right.
So I have two important inputs. First is we spoke about this big becoming bigger theme globally. Think about it. 15 years ago, if people thought about playing this trade, right? That US had the same thing. There
Yeah.
was a huge margin of safety. Had we thought that this is a 2-year tactical trade, it has gone on for 15 years.
Correct.
In United States, right? So right now we know that there is margin of safety. We don't know how long will it run.
Right.
That I think is a possibly an answer that I can give only in future, right? When will we reach there,
Yeah.
and what are the drivers for it? So right now we only know that there is margin of safety, and we also don't know whether this is the bottom or not.
Okay.
Let me tell you that also.
Okay.
Right? We don't know whether this is the bottom, but
Yeah.
it is close to something which we haven't seen earlier.
Yeah.
So that gives you a margin of
Sure.
safety. And second thing is that earlier we spoke about polarization and depolarization phase. We have seen some difficult market trends. For example, 2008, where global financial crisis occurred. We saw 2018, where huge amount of selling happened in small and mid caps. We also had a tough market in 2011, right? In all these phases, polarization occurred, okay, where select few stocks did brilliantly well, right? For example, post global financial crisis, defensives like IT, pharma, other companies in FMCG, they did brilliantly well, while rest of the market did not do much, right? The point is that what was the starting point of this phase? It was very high valuations across the market, and we are not very different from that phase right now. So when you go to the market today, what you are being offered in the market, when you open your screen, when you look at stocks, when you read what is being written, you are being offered small cap, mid cap, thematics, sectors, something which has done well over the last 4 or 5 years. We are telling you to look the other way. Look where others are not looking, look where flows are not going, which is the largest cap universe, and we think that it will do well. Second is the phase where depolarization occurs, where the broader market does very, very well.
Yeah.
Even in that phase, the largest 10 companies, they underperform, but the extent of underperformance is not very large.
Right.
Okay, so they participate, they make less money, of course, but you are not out of the market. You are still carrying the market leaders, you are still with the market, so there will be returns slightly lower than the broader market, but you will be participating.
Sure.
Right.
Sure. So in the meanwhile, we finish our discussion with Sahil. Participants are requested to post their questions in the chat box. Once we are done chatting with Sahil, we will take your questions one-on-one. So yeah, over to you, Sahil, again.
Sure. And also one key input in this overall strategy is the volatility part, right?
Sure.
When a lot of people invest in small cap, mid cap, we think that they are volatile segments, and because of the volatility, you will be knocked off. And also there is a thought that if you have a very concentrated portfolio, there is a possibility that it could be more volatile.
More volatile.
Right?
Yes.
Because one company could be, could have
Yes.
a situation where the returns are very low, etc. In case of this portfolio, which is Nifty top 10 equal weight index, the volatility matrix is not very different from the broader market.
Okay.
Right? So for example, over the last 20 years, if Nifty index has a volatility of 21.6%, this index has about 22.8%. When you look at the full series data, which is from 1997, Nifty and this equal weight, top 10 equal weight has same volatility, very similar volatility profile.
Why would that be, if you could expand on that?
So largely I think it is because larger cap companies, when you are talking about the largest companies, usually it takes a lot to move these companies.
Okay.
Right? They have such a large market capitalization that in bull markets you will find it harder for these companies to run faster. One critical input I think which I want to give you today of what I think could be the case going ahead is historically large cap companies have got huge amount of FI participation. Okay. And how much, and I will link this to volatility because it is very critical, the question that you asked. So for example, all of us have this expectation that lot of FI flows can come into India, right? and we've been waiting for it forever. They haven't come yet.
Correct.
But let's assume that it will happen someday, right? So in the overall passive global indices, let's say MSCI Emerging Market Index, India has a weightage of 20.33%. Out of that 20.33%, the top 10 stocks which are part of this index have a weightage of 6.5% roughly, 6.3 to 6.5%, which means that 1/3 of all flows coming to India could come into just these 10 stocks, right? Historically, people have thought about large caps as sort of a liquidity insurance, where they think that if huge selling were to come into the market, first people will go towards large cap because they are also available in the derivative space. There are futures contract there, so they could become more volatile, right? And that was the case historically, which shows up in the volatility number. But in this cycle, we haven't seen the kind of FI participation that we saw historically, and therefore the extent of selling, even in an adverse market situation, in these large names could be lower than it was earlier. So my expectation is that the volatility profile may not differ too much from what we have seen historically. It of course could be slightly different, but I think the portfolio will have, you could say, similar volatility outcome, but as you know, the return outcomes are more favorable in the past. The
margin of safety is also far
margin of safety is far more higher, and also as I said, if you think FI flows are going to come in into let's say Indian equity markets, then this is the basket of stocks which can attract one of the highest flows.
Sure.
Yeah. Another point which we made earlier is the relative attractiveness. Okay, so when we talk about, let's say, the broader market, NSE 500, which is a broader index, it's trading at about 27, 28 times earnings, trailing earnings, while the top 10 stocks are trading at 23.5, 24 times earnings. So there is some sort of a relative comfort here, and the word is relative, which means that at no point am I saying that 27 or 24 times is cheap, right? It's not cheap. So it's a relative play, not an absolute play. Even in case of price to book, the top 10 companies are available at lesser valuation versus the broader market. Okay, and we should actually think about this relative valuations in the sense that if you look at the screen, you will find that the relative valuation of top 10 stocks versus the NSE 500 is available at this green zone that we have shown in the chart, which is relatively, let's say, if you go back in history and you say that I don't know whether a crisis can occur or not, nobody knows, right? Outside of any crisis, this is one of the best relative valuation picture that is available, or high margin of safety which is available to invest. So as we said, 2-3 key points, and then maybe we'll talk about the portfolio, these top 10 companies, what is the constitution. But one, this polarization or big becoming bigger theme can come into force. There is a price favorability right now in terms of relative performance. Second, valuations are much more attractive compared to the broader market. People are rushing towards the other segment. Flows also tell you that nobody wants to be in this market. And third, the strategy is very sound. It is an equal weight strategy. It has a proven track record in other markets, other areas, and we have also showcased in Nifty 50 equal weight that this is a strategy which works very well over time. So these are some of the nuances that we should keep in mind.
So as you just mentioned, I think people might be interested in knowing what is the index composition as we speak.
Sure. So we've been highlighting through some of our collaterals that there are certain sectors where valuations are favorable. For example, when you look at Nifty 50, which trades at about 24-25 times earnings, and if you do it X of BFSI, the price to earnings multiple goes to 28 and a half, right? So Nifty is at 24, rest of the market X of BFSI goes to 28. If you just take BFSI, it goes to 18. So this is a segment which is more favorably priced right now, right? So when you come to the top 10 index, it has about 4 banks, right? So 40% of the portfolio is into banking, and all 4 the largest banks, private sector, all private sector banks are there, large 4 private sector banks, and this is the portfolio. So you have HDFC, you have ICICI, you have Kotak Bank, and you have Axis Bank.
Okay.
So relative valuation comfort. There are 2 technology IT companies, Infosys and TCS, again the 2 market leaders. Maybe these companies may not be the cheapest versus their history, but certainly they are underperforming the broader market over the last 2.5 years. So they are devoid of any price froth, right? So first sector, banks, where there is valuation comfort. There is also no price froth, underperforming Nifty over the last 5 years by 4.5% CAGR, right? So both favorably placed in terms of price and in terms of valuation. IT favorably placed in terms of prices, and then you have 2 FMCG companies, ITC and HUL, where again price froth is absent, underperformed.
Yes.
Again, valuation wise, you can't say that they are at the cheapest, but when you compare it to the rest of the market, what is going on right now in the market, they will appear relatively better placed, right? And then you have RIL and L&T, where valuation is slightly more tougher because they are conglomerates. To create, and you have to look at them more from a bottoms up point of view, but both market leaders. So the complete portfolio gives you a mix of about 3 sectors. I'm not talking about RIL and L&T, but other 3 sectors, which is banking, IT and FMCG, where either you have valuation comfort or there is no price froth, or both. So it gives you a much better portfolio in terms of where you can enter today when you look at the broader market. Also, when you look at the return ratios, for example, if Nifty ROEs are at about 15-16%, this portfolio has an ROE of about 22.5.
Okay.
So much superior profile in terms of overall return on equity. Return on assets look optically high at 10.4, only because it's an equal weighted portfolio. The right comparison is Nifty 50 equal weight portfolios ROA, that is also 9%.
Okay.
But this has even more superior ROAs, right? So high ROEs, high ROA, overall valuations are also better, and the portfolio profile is also very, very superior.
So on the portfolio, I had a couple of questions.
Yeah.
I was just discussing with a couple of people before our discussion. So they were questioning that, they may miss out on certain sectors, which is part of the Nifty 50,
right,
but probably not part of your Nifty top 10, like healthcare, you have auto, metals,
right,
auto, something. So how would you address or how should somebody navigate that thing in his mind to go with this product?
So one way to think about it is that with this portfolio, with the top 10 companies, you are playing with the wisdom of the market.
Right.
Where the highest profit pools and companies which have done brilliantly well over time, they come and constitute the top 10 index, and you stay with them.
Right.
If there are companies and sectors which outperform everything else, they will come and become part of this index, right? So this is a concentrated index, and it will be like that. It will never have, because we have 14 sectors, so 14 sectors cannot get consumed in 10 stocks. It will never happen, right? So it will always have some sectors which will get represented here. The idea is that if you want a more sectoral diversified portfolio, we already have Nifty.
Correct.
That we offer. We already have a Nifty equal weight. We also have a next Nifty 50. So we already have offerings. So if you have a requirement for more diversification sector wise, of course there are other options, but this is the play where, as I told you, margin of safety and appropriate diversification is available. It may not be the highest, but it is appropriate.
There are also questions where people ask that, this is a typically an institutional product, or this is a typically HNI product. How would one play this in a retail portfolio?
Sure.
Because I think taxation is in favor of the product. A lot of other, off-market transactions gets taken care of with respect to the structure. So how would you address that, this is a product for anybody?
Sure. So first thing is that these 10 stocks constitute almost 54% of Nifty 50, right? which itself is 60% of the market. So these 10 stocks are about 30-35% of the overall market, which means that most people anyways own them. But when you own them on your own, and if you receive a dividend, if you do a rebalancing, if you sell some stock, book a profit, etc., you pay tax. Within a mutual fund structure, you don't have to do it.
Yes.
So one of the best ways to hold on to these large cap companies forever is this product, right? Where you continue to hold it, and even when it rebalances and does profit booking, unless you redeem, there is nothing to be done, right? You can enjoy the compounding for as long as you hold this kind of a product. So that makes it suitable for any investors who hold these 10 companies, which I think most people do, whether they are retailers or institutional investor or otherwise. Otherwise, they would have never become the top 10 stocks, right? So they are the mainstay of the Indian market. And second, and more importantly, in any portfolio, currently the allocation to large caps is low. And there are two reasons for it. One, a lot of investors, as I showed in flows, have chased the other part of the market. Second, because it has delivered very high CAGR within those portfolios which has not even chased that part, because of the market cap gains, they have become much bigger. Right? The market cap for other segments have exceeded the gains in large cap, and therefore they have become much bigger, right? So if you want to add more large caps, if you want to rebalance your market capitalization allocation, then this product will give you a direct kicker, right? It gives you the largest companies, and which we have seen through the presentation that they do well.
And in a much more cost efficient manner.
One of the most cost efficient manner. When you want to own them, I don't think there is any better way to own these large cap companies in any other format.
For somebody like a treasury or a PF, how should they look into in these kind of products? How would it address their product requirement?
So largely, I think again Nifty 50 or the top 30, Sensex 30, these products have been the mainstay where they have tried to participate with these products. But I think over time, this kind of index, which is more concentrated, will also have an audience.
Right.
And the reason is that it will give you direct exposure, but only 10% to each stock, right? So it doesn't overexpose you to a very specific company. For example, when you take a market capital, free float market cap based index, even when it has 30 or 50 stocks, there are single stocks which I have 13, 14, and even in the past gone above 15% weightage. Right? So when you are just replicating the overall index, in some of the sectoral indices, there are many indices which have 10 and 12 stocks, many indices, right? In those indices, many stocks go up to 20% weight also, right? But this is an index because of this 10% weightage, because it's an equal weight, 10 stocks, 10% each, it gives you a much more favorable, longer term view of the portfolio. So I think that could become a good, important input for a number of institutional investors.
And one last question. As you said that this strategy has played out very beautifully in the US.
Right.
Have you seen similar trends globally also in the rest of the geographies?
In rest of the market, see why US this trend has played out is because there have been a lot of large cap companies which have done very well.
Okay.
And the reason is because of many technology companies residing in US and doing business elsewhere, they have done quite well. Some of these trends have also played out in China.
Okay.
Right. Many smaller companies haven't done well, but of course there is no top 10 sort of an index which we can directly correlate with. But when we looked at data, many large cap companies have done well over a period of time, select few versus the broader market, a market where nothing much has happened over time, right? And in many other parts of the world, even in Brazil, some of the large companies have done exceedingly well. So it's a strategy which has a sound underlying principle and a logic.
Sure.
And of course, please remember that it's a cyclical strategy. It's not that it is always going to outperform the broader market every year. That is not the case, right? There will be periods where it will have very large underperformance, very large outperformance, but over a full cycle, it has done well. And also one more point, in India, small and mid caps were doing equally badly or equally good like large caps. Until 2019, until before COVID, there was not much difference. In fact, large caps were ahead.
Right.
in US, large caps are still ahead of mid and small caps over a 20-year period, right? So as I said, these are cycles and they will play out differently over time. Our idea is to offer this product at a time where the margin of safety is very high.
Sure.
And that I think is the most important point.
Any closing remarks before we start taking the questions?
Closing remarks is that you should definitely evaluate this strategy and look at your asset allocation and also think about going the other way, right? And when you are thinking about allocating to many themes, many ideas, many hot sectors which are sort of appearing to be the best case, this is something which is different from what you are hearing today. And usually we've seen that fashionable things which appear very shiny, they may not be the most appropriate at that point in time.
Sure.
Things which don't appear too shiny, which is the largest cap companies as of today, usually they have better margin of safety. So this is sort of a good point in time to reevaluate the largest cap companies.
Sure. Thank you. We have our first question. What will be the frequency of the rebalancing?
So rebalancing happens every 3 months, which is the rebalancing of weights. Okay. But the reconstitution, where the stock may change, will happen 6 monthly.
Okay.
So every 6 months, the index will be reconstituted by NSE, and that is how it will work.
Okay. What is the typical overlap of this index over Nifty 50? I think you had mentioned.
Yes, about 54%.
54%.
In terms of these 10 stocks have a 54% weight in Nifty 50.
Okay.
So they have they crowd out many other stocks because of course they are the largest ones.
Sure. If you can discuss a couple of return ratios, return of assets, ROE.
Yeah. So for ROEs, for example, for this portfolio is about 22.5.
Okay.
Very hard to find many portfolios with this ROE profile in India. ROAs are about 10% plus, but that's a technicality because it's an equal weight portfolio. You have BFSI also, so you have to be very careful when you look at ROAs.
Okay.
But ROEs, I think, is a better profile. Price to earnings ratio on a trailing basis is close to 23.5.
Okay.
Or so overall. For these 10 companies, earnings growth over the last 4-5 years has been around 22%, 4 years or so.
Sure.
Right now it is slightly slower, going on at about 10% or so. But there are many segments where, for example, BFSI is still continuing very well in terms of earnings growth.
Right.
And some earnings growth is coming back to the staples space. Right?
Okay.
So the underlying appears to be more robust right now.
Okay.
Yeah.
Fair enough. So I think we've covered most of the things today. Sahil, thank you so much for your time. If you refer our previous Netra documents, 2022, we had given a chart on the attractiveness of defense space, the attractiveness of healthcare space, the attractiveness of small and mid cap space, what we just mentioned. In 2023, we gave a chart on the attractiveness of gold. And you should track how beautifully these calls have played out. There is a similar chart which we have shown in the latest Netra edition on the attractiveness of the largest caps, which is the top 10. And we are launching that in our offering, which is a Nifty Top 10 Equal Weight Index Fund. The NFO opens on 16th of August. If you need more details, you can refer to our website. You can reach out to your relationship manager. You will also see more and more communications from our side to help you understand the product a little more better. So do participate in the strategy because, as Sahil said, you are actually buying underperformance. We are not trying to chase returns. The metrics are looking very attractive. The fundamentals are very strong, and we believe it is likely to do well over a period of time. So thank you so much for your time. Good, and have a nice day. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.